Some of you guys were asking about like I'm always talking so good about real estate. What's wrong with it as an investment? And I thought it was good to share. I made a video about this, but I'll go through this with you guys. So, as an investment, when we're talking about multifamily, commercial, institutional quality real estate, class A or best in class real estate, great locations, as investing your taking your money out of the bank and converting it into real estate as a passive investor, what's wrong with it? So, what's wrong with real estate? We'll go wrong. What's wrong with it? Number one thing, it's expensive. As an asset class, yeah, as an asset class itself, real estate is expensive. It's not, you need money. Like, so some of you guys are out there who are flipping properties or doing fixer-uppers and things like that. Yeah, you may be able to get a seller to seller finance a deal. But as you start getting into commercial, multifamily, institutional quality real estate, it's an expensive project. You're going to need equity. You're going to need the facilities to be able to get that. And you're going to need the debt. You're probably going to go to Fannie Mae, Freddie. You're going to go to a life insurance company or a debt fund, and you're going to have to raise the equity. Deals we look at for $50 million, 75, 100, $120 million deals, sometimes $200 million deals. And you're going to need to put down 40, 50% of that. So it's going to require something. So real estate as an investment opportunity is an expensive vehicle, right? As an asset. So number two, it requires management. I'll just put that. It requires professional management. So, like, we don't have a management company. We use third-party management, Greystar, Avenue 5, like other property management companies that are registered. Let's say they're CPMs, which are certified property management firms or companies. Greystar is a big company. They have 900,000 units, and I want to say probably about 500,000 of those they manage. So that's a professional thing. It requires professional management. You're going to need a team on the ground, a leasing office, and a management agent, or the actual executive team on site, maintenance people, contract services, pool cleaners, landscaping. Like it requires heavy lifting as it relates to managing that asset. And you also, like, from my perspective, we have a fund, right? So as a team, you're going to need a finance department, accountant, CPAs, a controller, legal, investor relations team, acquisitions team, CIO, which is your executive team that deals with your investment officer, right? He's your investment officer that handles all those things and oversees those, as well as acquisition. Like, managing the investment is not just managing the actual real estate asset itself, but the asset itself requires managing. So next, um, it requires, and I'm going through this because I wrote it down. So it requires big money, which I talk about being here, but when you really look at it, just the operations alone, let's say you have a property that 40% of all your gross revenues on the average, depending on what city you're in, is going to require, it's going to take up about 50% of your income. So if you have a property that's generating 10, $20 million a year in gross income, 50% of that's going to be an expense. It's going to be your expenses, your taxes, insurance, all of the stuff that requires that property to operate and run. And that's going to change every year. It goes up, it goes down. Some years are worse than others, depending on what's going on. You got floods, you got hurricanes, you got fires. You have a lot of stuff to be able to be responsible for. So, these big requirements of big capital as it relates to the expenses are concerned with that property. It does matter when you're looking at this stuff. So, the other piece as it relates to what's wrong with it is you don't have these big bangs. That's a big bang. So like unlike big bang meaning like look Bitcoin. Bitcoin's spikes went all the way up from 80,000 to 120,000. I think today it went back to like 80 something thousand and now it's at 90. There's at 90 today. So like you don't have the big bangs and this big explosions in your investment opportunity or your investments in real estate. Real estate's steady Eddie, man. It's like you don't need to. This is not a get rich quick thing like stocks. It is a get wealthy for sure. It's even, it's steady, it's heavy. You can't just press a button today because things went wrong and you can't just sell it. That's not how this stuff works. Um, So that's huge to kind of know. So like what's wrong with real estate? Like whatever you invest in, it's going to be there 7, 10 years, 20 years. Think about it. The Vatican's been 2000 years. Like that real estate is still there. But just like I said all the time, even though that's wrong, it's not bad. Like it actually protects you. And there's another one too. I'll write it on another page. I wasn't expecting to devote this much time writing, but it's a liquid, which goes right back to like you can't just press a button. It isn't a liquid investment, meaning like you can't just sell your real estate today, just like I said with stocks or Bitcoin or something. But I actually believe that by it being illiquid, it's also a plus. Like that's not a bad thing. So that if you've made an investment in an opportunity and you're going to be in that deal for 7, 10 years, right? Or let's say you're 40 years old and you have a business, you got a family you're running, you make an investment in real estate like with Bell Capital or whatever. Um, and we say it's going to be a 10-year hold on that property. I can refinance, give you your money back in 3, 5, 7 years, but it's going to be 10 and I can still move it past 10 if the market's bad. Let's say that. You can't just go and get your money out. That some people hate that. They're like, oh, I want to be able to get it out. But if you can't get your money out, then you have to focus on what? Generating more income in your business, whatever it is, whatever, like you can't just go fund an emergency based on your investments. And that's not what you should be doing anyways with your investments. If you have an emergency, you go focus on generating more revenue or telling people, dude, I can't take care of that. You guys are going to have to handle it. Your investments are your investments. So that's the other what's wrong with real estate. And this is what people hate the most. It's illiquid, but I don't really think that's a bad thing. So what's right with it? What's right with real estate? I know this is super sloppy today. One, it's proven. I just talked about that. It's already has this mass adoption. It's so proven. Like people already accept the fact that how people need housing. Multifamily real estate. It's not like when I was a kid, when people didn't want to rent. Like now, people are, it's called renting by choice. People live in apartments. They want to be there. They want to travel. They got a nice apartment. They have great amenities, best in class amenities. They got a gym, swimming pool. Some people's gyms at like assets we look at are better than like 24-hour fitness and LA Fitness and all these other stuff. Like the facilities are great. And they're done that way for a reason because now people live in apartment buildings as a resident based on the community that's there, right? That's the stuff we look at. So that's number one. It's a proven asset class. So if you're going to make an investment in real estate, you already know that there's mass adoption. People are going to want to live there. People need housing. That ain't going away. Next is stable. Like I said, with the fact that the other one is like you don't have these big bangs, the fact that you make an investment in real estate, it's a stable investment. You already know what's going to happen. It's not just going to come undone. Like it's not how it works. So next, you have appreciation, and that's through rents. So you can raise or control your appreciation in that asset through rent. So if you have rents that typically go up, rents typically go up in this country, they kind of double every 10 years. That's kind of a marker that I have in my head. But if you just simply just say, look, rents kind of go up anywhere between 3 to 5% a year. They go up more than that, sometimes less than that, but that's pretty much on the average, and that's happened 8 to 9% since 1945, but on the average since forever. So if you know that rents are going to continue to go up, then you also have this natural slash forced depreciation in your in your investments with real estate, right? That's what I look at. Um, when I'm looking at any deal, those are the things that I pay attention to. So next, it attracts, I'll just say cheap debt. Real estate itself as an asset class always attracts cheap debt. So you don't like you won't have like some I don't know, 75, $80 million apartment building deal with Fannie, Freddie, and they're looking at 65% loan to value with 12% interest rate. Like that's, you're not going to find that, not at a commercial level institutional quality asset that is stable. It's great. You're buying it at scale and things like that. So it attracts cheap debt as an investment or as an asset class, unlike other things. You can't go borrow a bunch of money for stocks and you can't borrow like it's just different. This asset class is very clean. And then next there you get great leverage. Great leverage. That's leverage. So That looks terrible. But anyways, like when you're making an investment in something like this, like for every $1, usually your dollar's worth $3 in an investment with good leverage. So that's why I like it because if you buy a dollar in stock, your dollar, you buy a dollar, you take a dollar, convert it to a dollar's worth of stock, that's what you got. But if you buy or you make an investment of a dollar in a piece of real estate with good leverage, that dollar is now worth $3 inside of a good piece of real estate. So that's a huge benefit, which is another reason why I like it. And last but not least, you have your tax benefits. There's multiple, but real estate tends to have the best tax benefits that I've saw. So I talk about this all the time. So you have your bonus depreciation, your cost segregation with the bonus depreciation that's happening right now. If you didn't have bonus depreciation, you have normal depreciation on apartment buildings is 27 years. On commercial property, it's like 34, 35, something like that. Um, and you get to write off your interest on your debt. You get to pass on a bunch of different things to your investors, my investors. You get all the benefits of being able, the tax benefits of this, and there's other ones as well. So when I think about that, yes, there's some things that aren't great about it. Like what's wrong with it? Well, I mean, it's expensive. You need a property manager. You don't have the big bangs like you do in some stock or Bitcoin or something like that. Um, it takes a lot of money to be able to operate these properties, but they pay for themselves when they do that, so that's not good. Um, what was the last one? I won't go over all of them, but oh, it's a liquid. It's a liquid. Most people hate that. They're like, oh, can I get my money out? No, like if you make an investment in a fund or something like that, and a piece of real estate is syndication, and it says it's a 5, 7, 10 year hold, you're going to be in that deal. So like that's one of the things people don't like about real estate as an asset class. It's not like stock where you can just liquidate immediately. It takes a lot of money. It takes a lot of time to sell a real estate deal. If you, let's say you have a 150 unit or a 20 unit deal or an 8 unit building. You can't just go to market tomorrow and sell it. You have to prep it. You got to get your management company right. You got to get your leases right, your financials in order. You got to tell your lender, your bank, depending on what kind of loan you have. It may cost you money to sell. Let's say you have a 3 year loan and you want to sell it in 2 years. You may have a prepayment penalty against that loan where you still got to, when it comes time to close, you have to pay. So there's so many more things that go along with the type of real estate as an investment that you have as a just an investor. You're just taking your money, converting it to an investment that you need to be aware of. So yeah, there's some things that are not best about real estate, but like I said, sometimes what doesn't kill you makes you stronger. And these things actually make this a stronger investment, not a weaker one. All right, so I hope that helps. I'm gonna run off to this meeting, and you guys have a great day today. Let's get after it. Boom.